Hello there. According to bank estimates, the UK's borrowing requirements will reach a record high in the next financial year. Pending bond sales by the BOE will further aggravate the situation. So investors are becoming familiar with the sheer scale of Britain's borrowing needs over the next few years, and it's not looking good. According to estimates by British banks, the net supply of British government bonds is likely to reach a new record in the next financial year. According to Citigroup calculations, in order to absorb this flood, the market will have to raise twice as much new money as it has in the past 8 years combined. According to the Debt Management Office, the UK's gross financing forecast is set to grow by nearly 50% to £1 trillion over the next 4 fiscal years. Barclays sees this as a significant deterioration in the medium-term picture. While the market cheered Chancellor Jeremy Hunt's package of tax hikes and spending cuts on last week's Thursday, the reality is different. The dizzying volume of future bonds is likely to put pressure on the market. There are already concerns that it may be difficult to find buyers, especially as the Bank of England is now looking to reduce rather than increase its gilt holdings. It's an unprecedented challenge in terms of issuance, said Citigroup bond strategist Jamie Searle in an analysis. We have been discussing the upcoming surge in gilt issuance for some time now. However, the market has not yet felt this directly. That is now changing. 10-year UK government bonds fell for the second day in a row on Friday. At times, their yield was more than 20 basis points above the previous day's low, which means that they have risen more than they have since the end of October. The yield level of 3.23% at the end of the week is still well below the more than 4.5% interest rate that investors were demanding when the budget plans of ex-Prime Minister Liz Truss caused a wave of fear in the financial market. Still, NatWest Markets sees the gilt yield rising more than a percentage point to 4.3% through the second half of 2023. It's hard to imagine that the usual buyers of gilts, that's foreigners and LDI, would find themselves forced to increase demand to keep up with supply, said Imogen Bakra, NatWest's head of UK bond strategy, referring to liability-focused markets investment strategies, that's the LDI, commonly employed by pension funds. Natural buyers may be hard to find at these yield levels, though. The Bank of England's bond sales, which wants to reduce its bloated balance sheet, will provide additional headwind. Their portfolio includes £835 billion worth of gilts, which she has acquired over more than a decade of quantitative easing. In addition, there are papers with a volume of $19 billion, which they bought in response to the financial market turmoil in September to stabilize the bond market at least. The market has just recovered from the pension fund liquidity crisis and could now be rolling into a debt financing crisis. That was the warning by Craig Zoll, head of government bonds at Royal London Asset Management. Even with tax hikes and spending cuts, borrowing conditions are worse than before. So, as I mentioned in my last video, the discussion about debt is not over yet. And I'll see you in my next video. I'll be back.